Hello, and welcome back to the channel. I'm Algabot, and this is where we take apart automated trading strategies for the MetaTrader 5 platform and study how they actually think. Today we're examining an expert advisor called Value Skew Breakout. It's a pure price action strategy, with no oscillators and no moving averages driving the decision. Instead, it reads where price closed inside a quiet consolidation to judge who was quietly in control, and it only accepts a breakout that agrees with that footprint. By the end of this video, you'll understand the concept, the code, and a candle-by-candle example. This is educational content only, so let's dive in. So what does Value Skew Breakout actually do? At its heart, this is a breakout strategy, but with an important filter built in. Traditional range breakouts take every break of a level, and that's exactly why they so often get chopped up. Many breaks are false moves that spike through an edge only to snap right back. Value Skew Breakout tries to separate the breaks worth respecting from the ones that aren't by looking at the story the consolidation already told. Here's the core idea. When price consolidates in a tight base, the strategy measures where each bar closed inside that range. If closes keep printing near the top of the base, with every dip getting bought back up, that's a sign of quiet accumulation, buyers steadily absorbing supply. If closes keep pinning to the lower part of the range, that points to distribution, with sellers in control. The strategy turns this into a single number it calls the value skew, the average location of every base bars close within the range, where 1.0 means all closes at the top and 0 means all closes at the bottom. The strategy only accepts a breakout when the direction of the break agrees with that skew. A break above the top is taken when closes were already clustered high, and a break below the bottom is taken when closes were already clustered low. On top of that, a compression filter built from the average true range insists the base is genuinely tight rather than an already extended trend. Stops and targets are also sized from the average true range, so risk adapts to volatility. This approach may suit traders who prefer structured, rules-based price action over a stack of indicators, and who like the idea of demanding confirmation before accepting a breakout. As always, this is educational information, not financial advice, and trading always carries the risk of loss. Let's walk through the exact logic, step by step. The expert advisor works on completed bars only. On every new bar, it takes the bar that just closed and adds it to a rolling history buffer, then checks whether there's enough data to evaluate a setup. It also allows only one open position at a time under its magic number, so a new signal is ignored while a trade is already being managed. First, the strategy defines the base. It looks at a window of bars immediately before the most recently closed bar, 20 bars by default, controlled by the RangeBars input. Across that window, it finds the highest high and the lowest low, and the distance between them becomes the base height. Next comes the compression filter. The strategy computes the average true range over its period, 14 by default, and rejects the setup if the base height is larger than the compression multiple of that average true range, 2.8 times by default. This keeps the strategy focused on genuinely tight bases and screens out wide, already trending ranges masquerading as consolidation. Then it measures the value skew. For every bar in the base, it calculates how far that bar's close sat between the bottom and the top of the range, as a fraction from 0 to 1, and averages those fractions. That average is the value skew. Now the entry logic. For a long, two things must line up. The value skew must be at or above the skew threshold, 0.58 by default, meaning closes were clustered high, and the most recently closed bar must close above the base top. When both are true, the strategy signals a buy at the ask price. For a short, the mirror applies. The skew must be at or below 1 minus the threshold, meaning closes were clustered low, and the bar must close below the base bottom, and the strategy signals a sell at the bid. Risk management is rule-based. The stop loss is placed a distance of ATR stop multiple times the average true range away from entry, 1.5 by default, below entry for a long and above entry for a short. The take profit is set at reward multiple times that risk distance, a default reward to risk of 2 to 1. Once the position is open, those fixed stop and target levels manage the trade to completion. Every input is adjustable, so the behavior can be tuned in the strategy tester. Let's look at the MQL5 code as it appears in MetaEditor. At the top are the input parameters you can adjust in the strategy tester. RangeBars sets how many bars form the base, 20 by default. SkewThreshold, 0.58, is the average close location a base needs before a breakout is accepted. Compression multiple, 2.8, caps how wide the base may be relative to the average true range. ATR period is the average true range length. ATR stop multiple and reward multiple size the stop and the target, and lots plus magic define the fixed position size and the identifier. Just above the signals, you can see the value skew being computed. The loop walks each bar of the base, measures how far its close sat within the range, adds those up, and divides by the bar count to get average POS, the average position. Now the long block. The condition reads, if average POS is greater than or equal to skew threshold, and the just closed bar's close is above the base top, the strategy acts. It reads the ask price as the entry, places the stop 1 average true range multiple below, measures that risk distance, and calls trade.buy with the stop and a target set at reward multiple times the risk above entry. The short block is the mirror image. If average POS is less than or equal to 1 minus skew threshold, meaning close is clustered low, and the close is below the base bottom, it reads the bid as the entry, places the stop above by the same average true range multiple, and calls trade.sell with a target that same reward multiple below entry. Both sides carry the strategy's name as the order comment. Clean, symmetrical, and entirely driven by price. Let's bring the logic to life on the chart. On screen, you can see a candlestick sequence with 2 horizontal reference lines tracing the base top and the base bottom of each consolidation. We'll follow one long trade and then one short trade, exactly the way the expert advisor would read them. Look at the first few candles on the left. Price is coiling in a tight band between the base top and the base bottom. Notice something about these candles. Each one is closing in the upper portion of that band. The lows get bought back, and the closes keep printing high near the top. To the strategy, this is the accumulation footprint, buyers quietly absorbing every dip. The value skew here is well above the threshold, because the average close location sits high in the range. At the same time, the band is narrow, so the compression filter is satisfied. This is a genuinely tight base, not a runaway trend. Now watch the breakout candle. This bar pushes up and, crucially, closes above the base top, not just poking through intrabar, but settling above it on the close. Both conditions are now aligned. Value was already skewed high, and price has closed beyond the top. This is where the buy entry marker appears, and the expert advisor opens a long at the ask. Immediately, the stop-loss marker is placed below, a set multiple of the average true range beneath the entry, and the take-profit marker is projected above at twice that distance, the default 2-to-1 reward to risk. Follow the next couple of candles. Price expands upward, the accumulation resolving into a clean advance. Each candle carries higher until price tags the take-profit marker, and the long is closed at its target. Notice how the entry was never a blind break. It was a break the base had already been hinting at. Now the market shifts, and we get the mirror image. After the push, price stalls and begins to build a fresh base higher up, once again between a new base top and base bottom line. But this time, study where the candles are closing. They cling to the lower portion of the range. Rallies within the band get sold, and the closes pin near the bottom. That's the distribution footprint, sellers steadily in control. The value skew is now well below the mirrored threshold, and the band is still tight enough to pass the compression filter. Watch the downside breakout candle. It drops and closes below the base bottom, a settled close beyond the lower edge, not just a wick. The two short conditions line up, value skewed low, and a close beneath the base. The sell entry marker appears, and the expert advisor opens a short at the bid. The stop-loss marker sits above the entry by the same average true range multiple, and the take-profit marker projects downward at the 2-to-1 reward-to-risk distance. Trace the final candles. Price slides lower, the distribution resolving into a decline, until it reaches the take-profit marker below, and the short is closed at its target. Once again, the break agreed with the footprint the base had already shown. Step back and see the pattern the strategy is really looking for. In both trades, it didn't chase the first break of a level. It waited for a tight base, read where the closes had been settling, and only accepted the break that matched that quiet lean, High closes ahead of an upside break. Low closes ahead of a downside break. That's the whole idea behind the value skew, letting the consolidation confess its bias before committing. Of course, not every break follows through in real markets. False breaks and losing trades are a normal part of any breakout approach, which is exactly why the fixed stop is there on every trade. That brings us to the end of our breakdown of the Value Skew Breakout Expert Advisor. We covered the core idea of measuring where closes settle inside a base, the compression filter that demands a tight range, the matched long and short entry conditions, the average true range stop, and the 2-to-1 target, and we watched it all unfold candle by candle on the chart. Remember, everything here is educational information only and not financial advice, a recommendation, or a solicitation to trade. Every strategy carries the risk of loss, and no set of rules works in all market conditions. If you found this useful, please like the video, leave a comment with the strategy you'd like analyzed next, and subscribe for more MetaTrader 5 strategy breakdowns. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.